Okay, let's unpack this. You know how sometimes the news feels like it's speaking in riddles, throwing you a curveball when you expect a fastball?
Right.
Well, the financial markets just delivered a whopper of a paradox, a puzzle that seems to defy logic. And we are here to make sense of it for you, cutting through the noise to get to the core insights.
Exactly.
We're diving deep into the market performance of August 4th, 2025, a truly wild day that saw U.S. equities stage a powerful rebound, jumping with conviction, despite what was undeniably, unequivocally weak economic news.
Mm-hmm. A real head scratcher.
It is, right? Our mission today is to extract the crucial insights from the detailed market review you've shared with us, particularly the in-depth market review, August 4th, 2025.
Okay.
We're going to help you understand the why behind this counterintuitive rally, expose its underlying fragility, and explore what it might truly mean for the days and even weeks ahead. Think of us as your expert guides, navigating the labyrinth of data to reveal the hidden levers and surprising connections.
And what's truly fascinating here, beyond the immediate numbers, is how the market isn't just reacting to data. It's fundamentally recalibrating its entire outlook, almost in real time.
Recalibrating, I like that term.
We're going to connect the dots between seemingly negative economic data, the kind that would typically send shivers down investors' spines, and this significant upward movement. This isn't just about a one-day bounce. It's about a profound shift in investor psychology that could redefine your understanding of where we stand in the economic cycle.
Okay, so to really grasp this market paradox, we need to rewind a bit and understand the dramatic backdrop leading up to August 4.
Right, context is key here.
The market was certainly not in a great place. The prior week, for example, concluded with its worst performance since May, a steep, almost chilling sell-off that sent a genuine shudder through Wall Street.
Yeah, confidence was really shaken. People were bracing.
Exactly. And then Friday came, bringing with it what was widely described as a disastrous July jobs report. It felt for a moment like the bottom was truly falling out, that the economic gears were grinding to a halt.
Indeed, that July jobs report was less a critical turning point and more like a seismic shockwave. The numbers were unequivocally weak and, frankly, quite alarming.
How weak are we talking?
The U.S. economy managed to add a mere 73,000 jobs in July.
Just 73,000. Wow.
To put that in perspective, that was dramatically, jarringly below what nearly every analyst had been forecasting. The consensus expectation was significantly higher, closer to 150,000, illustrating just how big the miss was.
So less than half of what was expected.
Precisely. But it wasn't just the current month's poor performance that sent alarm bells ringing. What truly underscored the severity of the situation were the revisions to prior months.
Yeah, the revisions. They always get you.
They really do. Data from both May and June were revised downward by a stunning combined total of 258,000 positions.
250,000 jobs.
Yeah.
Just gone from the previous counts.
Wiped off the books, essentially. Think about that for a moment. It's not just that hiring slowed. Past strong performance was basically erased. This isn't merely a slight miss or a minor deceleration. This is a profound, rapid cooling in the labor market, signaling a significant loss of economic momentum.
So it suggests things are slowing down much faster than we thought.
Exactly. This kind of data points to an economy that is rapidly becoming what many economists call a late-cycle casualty.
Late cycle casualty. Explain that a bit more.
Imagine an athlete who's been performing brilliantly for a long race, but is now clearly hitting the wall, showing signs of exhaustion. That's our economy. After a sustained period of expansion and strong growth, it's now exhibiting the classic symptoms of slowing down, potentially approaching the end of its growth cycle.
So businesses hiring less, maybe consumers pulling back?
That's the implication. It means businesses are hiring less, consumers might be tightening their belts, and overall demand is weakening. This isn't just an abstract economic term. It has real consequences.
And the political reaction was quite something too, wasn't it?
Oh, yes. The political dimension was also stark. The Trump administration reacted swiftly and dramatically by firing the official responsible for compiling these very numbers.
Wow.
It highlights just how sensitive and impactful this economic data is, not just on financial markets, but on the broader political landscape and public perception.
Okay, and here's where it gets really interesting, where the paradox truly comes into sharp focus.
This is the crux of it.
Instead of plummeting further, instead of deepening the despair, the market reversed course with astounding speed on August 4 and rallied with genuine conviction. It's truly counterintuitive. This is the core riddle we're talking about. The bad news is good news dynamic.
Yeah.
Economic deterioration in this peculiar environment isn't feared. It's actually cheered by investors.
Cheered is the right word because
yeah.
it's seen as a direct harbinger of easier monetary policy.
It's a truly bizarre dynamic, almost a participation trophy for economic weakness if you're not deeply familiar with how financial markets operate during certain very specific periods. How did such a devastating jobs report turn into a catalyst for a rally?
It's less bizarre when you understand the market's singular obsession in this phase, the Federal Reserve.
Ah, the Fed. Always the Fed.
Always. The mechanics of this shift in monetary policy expectations were incredibly dramatic and almost instantaneous. The very moment that weak labor data hit the wires, signaling that the economy was indeed weakening, traders immediately ramped up their bets on a Federal Reserve rate cut.
Like right away.
Instantly. Bets on a cut at the upcoming September meeting. Exactly. Think of it this way. When bond yields fall, bond prices rise, and this signals that the market is expecting lower interest rates because existing bonds with higher payouts become more valuable. It's a direct reflection of investor confidence that the Fed will act.
Got it. Were there specific yields that moved dramatically?
Yes, the benchmark 10-year Treasury yield, a key barometer for long-term borrowing costs, fell to 4.21%. Even more telling, the 2-year yield, which is much more sensitive to the Fed's near-term policy decisions and expectations, also dropped significantly.
So both short-term and longer-term expectations shifted.
Signaling a strong conviction that policy easing was imminent. This forceful movement in the bond market served as a powerful confirmation for the equity market's conviction that the Fed was now on a path to ease monetary policy. It acted as a direct validation of the stock market's cheerleading for bad news.
And this wasn't happening in isolation, right? There was already some debate within the Fed.
Crucially, yes. It's important to understand that this rapid pivot in market expectations didn't happen in a vacuum. It comes against a backdrop of a growing, increasingly vocal internal debate within the central bank itself. We've actually been seeing signs of a dovish wing already forming within the Federal Open Market Committee, even before this latest bout of weak employment data.
A dovish wing, meaning they favor easier money, lower rates.
Correct. The faction within the Fed that favors easier monetary policy, lower interest rates, more liquidity, typically to stimulate growth or fight off deflation.
And there was actual dissent recently.
Yes, the most recent FOMC meeting, in fact, featured the first 2-member dissent since 1993, with 2 officials explicitly calling for an immediate 25 basis point rate cut.
Since 1993. That's significant.
Very. This internal division, this clear fracture, suggests the Fed was already grappling with the idea of easing, with some members ready to act. The abysmal jobs report simply amplified those calls, giving the dovish arguments much more weight and urgency within the central bank's deliberations. ###C. The rally's fragile foundation.
So, if this rally is built on the hope of Fed intervention, rather than genuine economic strength, what does this all mean for the fundamental health and sustainability of the market?
Wow.
It feels incredibly precarious, almost like building a skyscraper on a sand dune, doesn't it? What exactly are its Achilles heels?
That's an excellent analogy, and it perfectly captures the underlying vulnerability. The foundation of this rally is precisely its Achilles heel. It is not built on fundamental economic strength, meaning the market isn't going up because companies are intrinsically doing better, or because consumers are spending more robustly, or because productivity is soaring.
Right.
Instead, it's built almost entirely on the expectation of a policy response, specifically a Federal Reserve rate cut to weakness.
So it's dependent on the Fed delivering.
Entirely. This introduces a profound and significant fragility because the market becomes completely dependent on future Fed actions and their public rhetoric. If the Fed doesn't cut rates as aggressively as the market now expects, or if future economic data isn't weak enough to justify those cuts,
the whole thing could unravel.
Very quickly and dramatically. It's a constant tightrope walk.
And you said this is typical of a certain economic phase?
Yes, this type of market behavior, where bad economic news is celebrated because it implies central bank intervention, is actually a classic characteristic of a late-stage economic cycle. It highlights a critical and potentially dangerous shift in investor psychology. Rather than seeking robust earnings growth or strong balance sheets, investors are now prioritizing liquidity and the prospect of cheaper capital from the Fed.
A sort of liquidity addiction.
That's one way economists put it. The market needs a constant infusion of easy money to to sustain its ascent. It signals a potentially dangerous decoupling between market performance and the underlying economic reality. It means that the market's primary concern isn't the health of the economy, but rather the availability of cheap money.
And you mentioned M&A played a role too.
Right. This macroeconomic driver was, of course, amplified by a surge in significant merger and acquisition activity on the day, which provided its own powerful upside catalyst for specific stocks. We'll definitely get into those details. But for now, it's crucial to understand that these two forces, the hope for Fed easing and the M&A boom, together largely overshadowed other persistent concerns that might otherwise drag the market down.
Like trade tariffs and earnings.
Exactly. Ongoing global trade tariffs, which we'll dive into later, and a generally mixed corporate earnings landscape where a closer look reveals some vulnerabilities. This is not a broad-based, fundamentally driven rally, but a concentrated, policy-dependent one.
Okay, so after that turbulent lead-up, let's talk about the market's specific performance on August 4. After that pretty rough 4-day losing streak that had really dragged it down from its recent record highs, the market finally snapped that trend.
Snapped it decisively.
And it wasn't just a timid bounce. The rally actually gained palpable momentum throughout the day, with each of the major indices closing near their session highs. That tells you there was real sustained conviction behind the buying.
Absolutely right.
What were the actual numbers telling us?
That conviction was evident in the closing figures. Looking at the specifics, the S&P 500, the broad measure of large-cap U.S. equities, jumped a significant 1.5% on the day.
1.5% is a solid move.
It is. Rose 91.93 points to close at 6,329.94. This pushes its year-to-date gain to a respectable 7.6%. A strong rebound for the broader market, certainly.
And the Dow?
The Dow Jones Industrial Average, representing those 30 large U.S. companies, also gained a solid 1.3%, adding 585.06 points to finish at 44,173.64. Its year-to-date performance now stands at plus 3.8%.
So the industrials joined in too.
They did, indicating some breadth beyond just pure tech. But the real star, the undisputed leader of the day, was the NASDAQ composite.
Ah, the tech-heavy NASDAQ.
Exactly. Heavily weighted towards technology and growth stocks, it surged a remarkable 2.0%. Jumped 403.45 points to close at 21,053.58.
2% is a big jump.
It is. This impressive gain for the NASDAQ, now up a robust 9.0% year-to-date, truly underscores a strong renewal of risk-on sentiment for the session. It signifies that investors, buoyed by those shifting interest rate expectations, were willing to move aggressively back into higher growth, higher risk assets, seeking out future potential.
What about smaller companies? The Russell 2000.
Even the Russell 2000, which tracks smaller U.S. companies, performed strongly, rising 2.1%, that's 45.52 points, to 2,212.030.
So small caps outperformed even the NASDAQ on the day.
On a percentage basis, yes. Though it's still down 0.8% year-to-date, its performance on Monday showed a broad participation in the rebound. But really, it was largely driven by that single macro narrative of anticipated Fed easing. The key takeaway here is a widespread belief that easier money is coming, and that belief drove capital back into riskier assets across the market.
So while the headline index numbers look robust, giving the impression of a rising tide lifting all boats, was this rally truly broad, or was it a bit uneven beneath the surface?
That's a very good question.
I'm curious about the underlying health indicators, like trading volume and market breadth. Do they tell a more nuanced story?
That's a crucial question because while the headline index numbers certainly painted a picture of strong recovery, the underlying market internals reveal a more complex, perhaps even a bit ambiguous picture.
Okay, how so? Let's start with volume.
Let's look at trading volume. During Friday's steep sell-off, the volume was exceptionally high, hitting 19.51 billion shares.
That's huge volume.
Huge. High volume on a downward move often suggests strong conviction behind the selling, meaning a significant number of participants were actively and forcefully dumping shares, signaling deep fear.
Right. So what about Monday's rebound volume?
In contrast, Monday's rebound saw advancers outpace decliners on the NYSE by a solid but not overwhelming ratio of 1,828 to 11,166.
So more winners than losers, but not a landslide.
Exactly. While this is a positive ratio, it's not a truly overwhelming stampede of buying across the board, which you might expect in a truly conviction-driven, broad market recovery. It shows an improvement in sentiment, certainly, but perhaps not a full-fledged universal endorsement of the market's future direction from every corner of the investor base.
Interesting. What about the VIX, the fear gauge?
Another key indicator, the CBOE Volatility Index, or VIX. It offers a glimpse into the market's collective psyche.
It spiked on Friday, right?
It did, spiked over 21% on Friday, reaching 20.38, signaling a significant surge in investor anxiety and an expectation of choppy waters ahead.
And on Monday,
On Monday, it eased significantly. Pre-market futures were indicating a drop of over 6% to around 19.08.
okay, so fear definitely subsided.
It tells us that near-term anxiety certainly reduced. A lower VIX generally suggests that investors are less concerned about sharp, immediate swings in the market, which directly aligns with the return of risk-on sentiment we observed in the major indices. So, while fear subsided and many stocks rose, the nuances in volume and breadth suggest a rally driven more by that strong macro theme rather than a universal shift in underlying fundamentals for every company. #C, megacap technology leadership and the AI narrative.
So with that backdrop of shifting sentiment and a complex internal picture, who was truly leading the charge on Monday? Was it a diversified group, or were certain sectors, or perhaps even just a few major players doing the heavy lifting?
Yeah, good question.
Maybe masking some underlying unevenness.
The day's rally was quite disproportionately powered by a resurgence in mega-cap technology stocks.
The giants.
The giants, the trillion-dollar companies that cast a long shadow over the entire market, they are particularly sensitive to shifts in interest rate expectations, and for very good reason.
Why is that? Exactly. Their valuation.
Their valuations often rely heavily on the promise of substantial future earnings growth, which are discounted more favorably when borrowing costs are lower. So the prospect of cheaper capital, those anticipated Fed rate cuts, provided a significant, almost irresistible tailwind for these growth-oriented names.
That's much more attractive.
Immensely attractive. Once again, it's a direct valuation boost.
And the AI theme was strong.
Very strong. Chip giants, which are absolutely central to the artificial intelligence narrative and the build-out of the AI economy, were among the strongest performers. NVIDIA, a key player in the hardware that powers AI, gained nearly 4%.
Wow, 4%.
While its rival Broadcom, another critical component supplier, rose more than 3%. These companies are not just benefiting from a general tech bounce. They are at the very epicenter of what many believe is the next great technological revolution.
And the rest of the Magnificent Seven.
Beyond the pure chip makers, other Magnificent Seven constituents, those highly influential mega-cap tech companies that have largely driven the market's gains this year also posted robust advances. Alphabet and Meta platforms, for example, each advanced more than 3%, while Microsoft and Tesla added approximately 2%.
So, broad strength among the biggest names. What does that tell us?
This leadership from a relatively narrow group of incredibly influential stocks highlights two crucial insights for you. First, the market's continued fervent reliance on the AI theme as a primary growth driver. Investors are clearly willing to pour capital into companies perceived to be at the forefront of AI, regardless of broader economic weakness.
Right. AI is still the story.
And second, it shows the powerful, almost magnetic effect that anticipated Federal Reserve liquidity has on the valuations of the market's absolute largest companies. When these giants move, they lift the entire market with them.
Often masking some of the unevenness we talked about.
Exactly. Masking some of the lack of breadth that we discussed earlier in the market internals, this is a concentrated rally driven by a powerful narrative and the promise of cheaper money.
Okay, so beyond the Fed's gravitational pull and the broader tech surge, what individual stories really stood out and moved the needle on August 4?
Wow.
It seemed like there was a significant, almost explosive burst of merger and acquisition activity that created some dramatic value unlocks for shareholders. Tell us of those.
You're absolutely right. While the Fed narrative set the broader market tone, a distinct wave of significant merger and acquisition announcements provided some of the most dramatic, company-specific upside catalysts of the session, leading to truly astonishing gains for shareholders of the target companies. This isn't just about stocks moving, it's about companies fundamentally reshaping themselves in a challenging economic climate.
Okay, who are the big winners?
First, let's talk about CommScope, KLM. Its shares skyrocketed an astonishing 86.01%.
86%.
In one day, 86%, making it the day's single top gainer in the S&P 500. This wasn't a gradual climb, it was a vertical ascent.
What was the news?
The catalyst. A definitive agreement to sell its connectivity and cable solutions, or CCS, business-to-electronics component maker Amphenol, for a total of $10.5 billion in cash.
$10.5 billion. This is a huge deal for CommScope.
For CommScope, this is viewed as a truly transformational transaction. Imagine a company drowning in debt suddenly being able to wipe the slate clean. The proceeds from this sale mean they can repay their entire debt load, redeem preferred equity, and even return a significant cash dividend to shareholders. It's a complete overhaul of their financial structure.
Gives them a fresh start. And what about Amphenol, the buyer?
For Amphenol, whose shares gained over 3% in response, the acquisition is highly strategic and complementary. It significantly boosts their presence in the fast-growing IT datacom market, particularly by adding crucial fiber optic solutions essential for the massive infrastructure build-out required for artificial intelligence.
So it ties back to AI infrastructure again.
It does. This is a clear win-win that addresses CommScope's financial vulnerabilities while simultaneously fueling Amphenol's growth in a key future-facing sector. It showcases how companies are strategically realigning to either deleverage or aggressively pursue growth.
Okay, who else saw big M&A action?
Then there's Steelcase, SCS, the well-known office furniture maker.
Right.
It saw its shares surge an incredible 63.44%.
Over 60%. Another huge jump.
Massive jump. A direct result of the company agreeing to be acquired by its competitor H&I Corporation for approximately $2.2 billion in a cash and stock transaction.
Okay, acquired by a competitor, was it a big premium?
Huge. The implied purchase price of $18.30 per share represented a nearly 80% premium to Steelcase's closing price on Friday.
An 80% premium. Wow.
Which absolutely justifies that powerful one-day stock reaction. When a company is acquired at such a high premium, it immediately prompts scrutiny. And in this case, an investigation by an investor rights law firm was launched into its fairness to Steelcase shareholders, looking into whether the board adequately protected shareholder value.
Makes sense. How did the buyer, H&I, fare?
Conversely, shares of the acquirer H&I fell over 9% on the news.
That's pretty typical, right? The acquirer's stock often drops.
It is a fairly typical market reaction. Acquirers often see their stock drop initially due to market concerns about dilution issuing new shares to fund the deal, the significant cost of the acquisition, and the inherent integration risks involved in bringing two companies together.
So the market punishes the buyer, rewards the seller.
It's a classic example.
Any other major M&A movers?
Finally, Uniti Group, Union I, also experienced a significant jump, with its shares rising 65.34%.
Another 60% plus gain? What was the story there?
This rally was driven not by a new announcement, but by the formal completion of its long-planned merger with fiber provider Windstream.
So a deal finally closing.
Exactly. The combined entity began trading under the unit ticker on August 4, marking the creation of a major new insurgent fiber provider in the U.S.
And the market liked that.
The market cheered the finalization of this deal because it's expected to create a more streamlined debt structure for the combined company, unlock significant operational efficiencies by combining networks and resources, and substantially enhance its competitive position in the rapidly expanding U.S. fiber market.
So becoming a stronger player.
It's about combining forces to become a stronger, more agile player in a growing yet competitive industry. And the market clearly believes the sum is greater than its parts here. These M&A deals aren't just about individual stock gains. They signal a broader corporate strategy amidst economic uncertainty.
Right, companies either shedding debt or going for growth.
Exactly. Companies are either desperate to shed debt or aggressively pursuing growth at what they perceive as opportunistic prices, reshuffling the deck in key sectors like fiber optics and AI infrastructure. It's a sign that even as the macro picture darkens, strategic shifts are accelerating at the micro level.
Of course, the market is a two-way street. For every soaring stock celebrating a huge gain, there's usually a story of struggle or disappointment.
Always another side to the coin.
What happened on the downside amidst all this positivity and M&A excitement? Who were the stocks that experienced sharp declines? And what were the underlying reasons?
On the other side of the ledger, contrasting sharply with the M&A beneficiaries, we saw several stocks experience significant declines, primarily due to disappointing earnings reports and a broader reassessment of valuations in what is still a somewhat risky and uncertain macroeconomic environment.
Shows fundamentals still matter.
Absolutely. This illustrates the market's intense focus on fundamentals, even amidst policy-driven rallies.
Okay, give us an example.
On semiconductor, ON, for instance, plunged a steep 15.64%.
15% down. That's rough.
Making it one of the worst performing stocks in the S&P 500. The company's second quarter earnings report was the clear catalyst for this drop.
What was wrong with the report?
While its revenue of $1.47 billion did slightly beat analyst expectations, it still represented a concerning 15% decline year over year.
Revenue down 15% year-on-year is not good.
No, and critically, its earnings per share of $0.53 missed the consensus estimate of 54 cents, small miss, but a miss nonetheless.
But maybe the guidance was the bigger issue.
More concerning than the raw numbers themselves was the commentary from CEO Hassan El-Khoury. He warned of cautious customer behavior and pronounced weakness in the automotive market, which is a major segment for onsemi.
Weakness in auto, okay.
And he directly cited uncertainty stemming from ongoing global tariffs and weakening end market demand as the culprits.
Connecting macro fears like tariffs directly to their business.
Exactly. This provides a stark, real-world example of how those abstract macroeconomic fears like trade tariffs and general economic slowdowns are translating into tangible, negative impacts on corporate performance and, consequently, on investor sentiment and stock prices. It's a clear signal that the macro headwinds are indeed biting some companies.
Who else got hit hard?
Then there's Figma, a company that plummeted a dramatic 27.20%.
Down 27%. That's a crash, especially after its big IPO.
It was a particularly dramatic reversal, coming fresh off a record-shattering IPO the prior week where it had seen spectacular gains. This sharp decline served as a forceful reality check for investors, effectively erasing the majority of its spectacular post-IPO run-up.
So what happened? Did Figma report bad news?
What's interesting here, and somewhat concerning, is that the decline wasn't caused by any company-specific news or negative earnings from Figma itself.
Really? So what drove it down?
Instead, it was fueled by a confluence of broader factors. These included a general shift in market sentiment away from highly valued growth stocks, especially those that had run up significantly.
Sort of a take profits mentality on the high flyers.
Partly that, and also explicit cautionary warnings from influential Wall Street strategists at major firms like Morgan Stanley, Deutsche Bank, and Evercore. They all caution clients about a potential market correction due to stretched valuations across the market, the ongoing tariff pressures, and weakening economic data.
So Figma became a casualty of broader market fears.
As a high-flying, high-valuation recent IPO, Figma essentially became a poster child for this renewed caution. It illustrates just how quickly sentiment can turn and how vulnerable richly valued stocks are, even without direct negative news from the company itself. It shows that even in a rally, fundamental skepticism persists.
Okay, one more example on the downside.
Lastly, TG Therapeutics, TGTX, a biopharmaceutical company, dropped a significant 18.15%.
Down 18%. What was their story?
The company reported second quarter earnings of 7.17 cents per share, which missed analyst estimates of 32 cents by a wide margin, nearly a 47% negative surprise.
A big earnings miss. That explains it, right?
Well, here's the paradox. What makes this decline particularly notable is that it occurred even though the company actually beat revenue expectations and, crucially, raised its full-year revenue guidance for its key multiple sclerosis drug, Briumvi.
Wait, they beat on revenue and raised guidance, but the stock tanked because they missed on earnings per share.
Exactly. This reaction demonstrates a market that is intensely focused on profitability and is ruthlessly punishing any perceived weakness on the bottom line. It signals that in the current uncertain environment, investors are prioritizing actual earnings delivery, particularly profitability, over mere top-line growth.
So revenue growth isn't enough anymore.
Not if the profits aren't there. For companies that may not yet be consistently profitable or who show any hiccups in their path to profitability, the market is showing very little patience, despite otherwise positive developments. It's a clear message. Profitability matters now more than ever.
Let's broaden our view a bit now. Beyond individual stocks reacting to specific news, how did different sectors perform on August 4? Was there a noticeable shift in where investors were putting their money?
Oh, definitely.
Because that can tell us a lot about the prevailing sentiment.
Absolutely. The sector performance was a critical tell. Monday's trading session marked a sharp, almost instantaneous reversal from the defensive posture that had dominated the prior week.
What was happening the prior week? Defensives leading.
To give you some context, during the week ending August 1st, utilities and consumer staples were virtually the only sectors to post gains. These are classic defensive sectors where investors typically seek refuge when they're worried about economic uncertainty.
Like putting money in the safest harbor.
Exactly. But on August 4, we saw a clear and decisive risk-on rotation.
So money flowing out of safety and into riskier areas.
Unambiguously. The rally was clearly led by cyclical and growth-oriented sectors. Information technology and communication services were at the forefront.
Powered by those mega caps we discussed.
Powered, as we discussed, by the strong gains in their mega-cap constituents like NVIDIA, Alphabet, and Meta. This indicates a renewed, aggressive willingness from investors to take on more risk in pursuit of growth.
Driven by the hope of Fed cuts.
Largely driven by the expectation of a more accommodative Federal Reserve. It's a direct response to the perceived promise of cheaper money.
Any sector's lagging badly.
Conversely, the energy sector continues to be a notable laggard over both the medium and long term. It's fallen 13% over the last 6 months as global oil prices have steadily declined.
Right, lower oil prices hurting energy stocks.
Partly due to concerns about global demand and a slowing economy. So while the broader market saw a significant bounce, the underlying sector performance tells you exactly where the conviction truly lies, primarily in growth and tech. But it's a conviction that remains highly contingent on that overriding Fed narrative of impending rate cuts. This isn't a fundamental economic strength-driven rotation, but a policy response rotation.
Speaking of corporate performance and economic health, how did the second quarter earnings season look overall, now that it's approximately 2/3 complete? What's the big takeaway from all those corporate reports?
Yeah, good to zoom out on earnings.
Because the market can look strong on the surface, but the underlying numbers might tell a different story.
You've hit on a crucial point. The Q2 earnings season has been, on the surface, quite strong, almost deceptively so. But beneath that impressive facade, it reveals some underlying complexities and even contradictions.
Deceptively strong, how so?
While we've seen impressive beat rates, 82% of S&P 500 companies have beaten their earnings per share estimates, and a robust 79% have surpassed revenue forecasts.
Those numbers sound pretty good.
Yeah.
Better than average.
Both of these figures are well above the respective 5- and 10-year averages, which suggests a strong performance overall. In fact, the EPS beat rate is actually on track to be the highest since the third quarter of 2021.
Q3 2021.
That's
So it's a boom time.
Exactly, a period of booming corporate profits. Furthermore, the blended year-over-year earnings growth rate for the S&P 500 stands at a robust 10.3%,
Double-digit earnings growth.
marking the third consecutive quarter of double-digit growth. This strong performance has been largely propelled by outsized contributions from just a few key sectors: financials, communication services, and information technology.
So again, concentrated strength.
It underscores their critical role in the overall market's health and masks some of the weakness in other sectors.
And what about themes within earnings? Anything stand out?
A dominant theme this earnings season, particularly in the tech space, has been the massive capital expenditure dedicated to building out AI infrastructure. It's a fascinating arms race.
More AI spending.
Tech giants like Microsoft and Meta have not only reported blowout earnings, but they have also emphatically committed to increasing their capital expenditure budgets by tens of billions of dollars in the coming months.
Tens of billions more.
This aggressive, almost frenetic spending on AI infrastructure is creating a powerful tailwind for the entire technology ecosystem, particularly benefiting chip makers and other hardware suppliers. It's a boon within a potential bust, almost creating its own microeconomy.
Okay, so earnings look good. AI spending is strong. What's the catch?
The catch: valuations. Despite this undeniably strong earnings growth, valuations remain a key persistent concern.
Still looking expensive.
The forward 12-month price-to-earnings, or PE ratio for the S&P 500, is currently 22.2.
And how does that compare historically?
To put that in context for you, this is significantly elevated compared to the 5-year average of 19.9 and the 10-year average of 18.5.
So well above average.
Considerably. What this indicates to you is that much of the positive earnings news, and indeed much of the future growth potential, is already aggressively reflected in current stock prices. This leaves very little room for error.
Price for perfection, basically.
Pretty much. If anything goes wrong, if earnings falter even slightly, if growth doesn't meet these already sky-high expectations, or if the economy slows more than anticipated, there's significant downside risk built into these elevated valuations. It's a market that has priced in a lot of perfection.
This earnings picture is clearly complex, but this all sounds very U.S.-centric. What about the bigger picture, those persistent trade tensions, the global markets, the geopolitical chess game that's always playing out?
Yeah, we have to look globally.
How are those pieces fitting into this macroeconomic puzzle? And how do they impact what we just saw on August 4.
You're absolutely right to connect the dots globally because the day's market movements were overwhelmingly dictated by shifts in the broader macroeconomic landscape, with investors navigating a truly complex web of cross-currents.
So the Fed was the biggest piece.
The Federal Reserve's seemingly forced hand by the weak jobs report was certainly the most significant macro driver. That abysmal July jobs report fundamentally altered the economic outlook, shifting the narrative from a potential soft landing, where inflation cools without causing a recession, to a much more concerning late-cycle casualty, where the economy hits a genuine wall.
Right.
The market's aggressive recalibration of Fed policy expectations, leading to that surge in September rate cut probabilities, unmistakably confirms the equity market's bet on a more dovish Fed. And as we discussed, the bond market, with its plunging treasury yields, powerfully validated this. It's a clear signal that a weakening economy is now directly translating into fervent expectations of monetary easing.
Which investors are cheering.
Paradoxically, yes, it's a liquidity-driven response to perceived weakness.
But what about the tariffs? They haven't gone away.
Not at all. While Fed policy clearly dominated the headlines, the persistent global tariff threat remains a critical source of uncertainty and a direct, tangible headwind for corporate America.
Still rolling out new threats.
The Trump administration has continued to roll out new tariff threats against dozens of countries, creating a pervasive cloud of uncertainty over global trade, with a key deadline for implementation rapidly approaching on August 7.
Any specific examples?
We've seen specific actions like a 50% tariff on certain U.S. imports of copper and Brazilian goods, and a 25% tariff on imports from India.
50%. That's huge.
These moves have, predictably, sparked sharp diplomatic rows and retaliatory threats from affected nations, escalating global trade tensions. But they've also prompted some nations, like Canada and Switzerland, to signal an openness to negotiate for lower rates.
A complex game of brinkmanship.
Exactly. And these tariffs are not an abstract threat. They are having a direct, tangible impact on businesses.
Like onsemi mentioned.
On Semiconductor, as we discussed, explicitly pointed to tariffs as a direct cause of customer uncertainty and weak demand in the automotive sector during their earnings report. This shows how trade policy directly transmits into corporate fundamentals.
And Apple warned about it too, didn't they?
Previously, Apple, a tech titan, had publicly forecast that these duties would result in a significant $1.1 billion hit to its results, demonstrating the direct financial impact. These tariffs create real economic drag despite the hopes for Fed intervention, raising costs, disrupting supply chains, and dampening business investment decisions. It's a constant tension between monetary easing and trade friction.
So how did global markets react to all this? Did they follow the U.S. lead?
Looking at the international market snapshot, global markets largely took their cue from the shifting expectations for U.S. monetary policy. Hopes for a Fed pivot boosted risk sentiment across several regions.
Europe.
European markets rallied strongly on Monday. Germany's DAX surged 1.42%. France's CAC 40 climbed 1.14%, and the UK's FTSE 100 gained 0.66%. This synchronized advance suggests that the prospect of a more accommodative Federal Reserve in the U.S. is a powerful enough force to lift global risk assets, at least in the short term.
What about Asia? They had more time to react to the jobs report.
The trading session in Asia, however, was more mixed, reflecting a delayed reaction. Markets there had their first full opportunity to digest the weak U.S. jobs data from Friday, so they were playing catch-up. Japan's Nikkei 225 fell 1.25% in response to that negative news, indicating their sensitivity to the U.S. economic outlook.
But China held up.
However, Chinese markets, perhaps shrugging off some of the tariff pressure or anticipating their own domestic policy responses, showed resilience. Hong Kong's Hang Seng rising 0.92%, and the Shanghai Composite gaining 0.66%.
And yeah.
Indian markets also staged a strong recovery, with their Nifty 50 and Sensex both closing higher, led by a rebound in metal and auto stocks, suggesting some specific domestic drivers. This illustrates how interconnected global markets are, yet with varying regional resilience and different speeds of reaction to specific economic and geopolitical pressures.
So after such a fascinating, complex, and paradoxical day where the market seemed to cheer bad news, what's on the immediate horizon?
What's next, yeah?
What key pieces of information could shape tomorrow's market, August 5, and potentially either reinforce this strange dynamic or shatter it?
Tomorrow, August 5, is poised to be a potentially pivotal session as key economic data, And another round of influential corporate earnings will truly test the durability and the very rationale of Monday's unexpected rebound.
Okay, what's the big data point to watch?
On the economic calendar, the most critical data release of the day will undoubtedly be the ISM Services PMI for July.
The services sector. Why is that so crucial?
This is paramount because the services sector accounts for approximately 70% of U.S. economic activity. It's the engine of our economy. It's a vital indicator of whether the weakness observed in the jobs report and the manufacturing sector is becoming more widespread and entrenched across the entire economy, particularly in consumer-facing services.
So above 50 is expansion, below 50 contraction.
Correct. So if we see a strong number, say significantly above 50, it could directly challenge the market's newfound rationale for an imminent Fed rate cut.
Because the economy wouldn't look weak enough.
Exactly. Investors might conclude that the economy isn't as weak as feared, thereby significantly reducing the urgency for Fed intervention. This could trigger a sharp reversal of Monday's gains as the bad news is good news narrative gets pulled out from under the market.
And if it's weak, below 50.
Conversely, a weak number from the ISM Services PMI would confirm that broader economic slowdown narrative, solidify those rate cut expectations we saw surge on Monday, and could provide even more fuel for the bad news is good news rally,
Reinforcing the bet on the Fed.
reinforcing the market's current conviction that the Fed must act. The stakes are incredibly high for the single data point.
Any other data worth watching tomorrow?
Other significant data points include the U.S. trade balance for June. This will offer insights into the impact of trade flows on second quarter GDP. It will be closely scrutinized for any early measurable effects of the escalating tariff situation.
See if those tariffs are showing up in the trade numbers yet.
Right. We'll also get factory orders for June, providing another granular data point on the health of the U.S. manufacturing sector, which has already shown notable signs of deterioration. Each of these reports has the potential to either strengthen or weaken the market's current fragile narrative, and traders will be watching them like hawks. #P. The earnings gauntlet continues.
And beyond the economic data, the earnings gauntlet continues, with some truly influential corporate reports on the docket for tomorrow.
Yes, more big names reporting.
These aren't just obscure companies. These are major players whose results can send ripples across entire industries and the broader market. Who should we be watching, and what insights can they provide?
Indeed, the earnings calendar remains packed with influential companies whose results and forward-looking outlooks could significantly impact market sentiment.
Anyone reporting after Monday's close?
First, reporting after Monday's close, we'll get the highly anticipated report from Palantir, PLTR.
Palantir, the big AI software name, right? Best performer this year.
That's the one. High-flying AI software company, best-performing S&P 500 stock year-to-date, making it a darling of the AI boom. Analysts are deeply divided on the stock.
Bulls versus bears. What's the market expecting?
The options market is already pricing in a potential post-earnings move of nearly 11%,
11% move expected. Wow.
indicating extremely high expected volatility. Its guidance and commentary on government and commercial contract momentum will be absolutely critical. It's seen as a bellwether for AI software demand and enterprise spending.
Will it keep flying or face a reality check?
That's the question. Then, before Tuesday's open, we'll see Caterpillar CAT report.
CAT, the global bellwether.
As a global industrial bellwether, a true barometer of global economic health, Caterpillar's results provide a key read on global growth, construction activity, and the real-world impact of trade tensions. Their outlook tells us a lot.
Who else reports before the bell?
We'll also get earnings from pharmaceutical giants like Pfizer, PFE, and Amgen, AMGN, offering insights into the healthcare sector. And BP, a major energy company, will report, influencing that sector amid falling oil prices.
Okay. And after Tuesday's close, anyone crucial then?
Finally, and perhaps most crucially for the tech-led rally, after Tuesday's close, Advanced Micro Devices, AMD, will report.
AMD. Huge for the chip sector, especially after onsemi's bad report.
Absolutely. Following the negative reaction to ON Semiconductor's report, AMD's earnings will be a crucial test for the broader chip sector and the entire AI narrative. Investors will be laser-focused on its commentary regarding AI-related demand, specifically for its specialized chips, as well as the health of the data center and PC end markets.
So weakness there could really hurt the tech rally.
Any weakness here could ripple through the tech sector, potentially reversing some of Monday's gains. Conversely, strong performance and optimistic guidance could reinforce the positive AI story and provide further fuel for the tech-led market.
So these reports provide real-world data points against the macro narrative.
Exactly. They aren't just about individual companies, they provide a mosaic of the broader economic and industry landscape, offering real-world data to either support or challenge the market's current policy-driven optimism. Hashtag concluding analysis.
So to bring it all together, Monday's powerful rally has truly set the market on a knife's edge.
A very precarious balance.
It feels precariously balanced between the intoxicating hope of a Federal Reserve bailout through imminent rate cuts and the looming, very real fear of a genuine economic slowdown, one that's potentially exacerbated by these protectionist trade policies and global tensions. It's absolutely crucial to reiterate. This session on August 4 was not a vote of confidence in the underlying strength of the economy.
Not at all.
It was fundamentally a high-stakes bet on monetary policy, a gamble that the Fed will step in and provide the liquidity the market craves.
Precisely. This sets up a data-driven showdown for Tuesday, August 5. The ISM Services PMI will be the next major piece of evidence, the next crucial data point, to either validate or discredit the market's new dominant narrative.
That bad news is good news narrative.
Yeah.
This idea that bad news for the economy is paradoxically good news for stocks because it brings those coveted rate cuts closer. A strong report, indicating resilience in the services sector,
Could pop the bubble.
could trigger a sharp reversal as those rate cut odds are pared back by traders. Conversely, a weak report would likely be met with further cheers for an impending Fed pivot, potentially extending the bad news is good news rally.
However fragile its foundation.
Exactly. Therefore, Tuesday is not just another trading day. It is a critical test of the market's conviction, a referendum on its core belief system right now. The reaction to the ISM data will reveal whether investors are more afraid of a recession and its fundamental impacts, or more hopeful for central bank intervention and the liquidity it promises.
Setting up a potentially volatile day.
This sets the stage for a potentially high volatility session where the market's true priorities will be laid bare. Traders will be watching to see if the tech-led rally, fueled by AI enthusiasm and anticipated liquidity, has the strength to continue its ascent.
Or if reality bites.
Or if the underlying warnings from corporate earnings and the persistent tangible threat of tariffs finally begin to take precedence, pulling the market back down to earth and forcing a reckoning with economic reality. And if we connect this to the bigger picture, given how deeply interconnected global markets and policy decisions are, and how rapidly narratives can shift from economic fundamentals to central bank actions, what might be the unseen ripple effect of today's market paradox in your own daily decisions, beyond just investment in the coming months? How does this strange interplay of forces change the way you perceive the broader economic landscape around you?
That's a truly powerful thought to leave with, isn't it? The way these massive complex forces play out in the financial markets truly has a way of touching all corners of our lives, often in surprising and unexpected ways. Thank you for joining us on this deep dive, for navigating this paradoxical market with us. Stay curious, stay informed, and we'll see you next time.